Okay, housing headline hype heightens homeowner hesitation. I know what's happening right there. People are getting a little bit antsy with respect to what's going on in the housing market. And the Fed's basically saying we're in a bubble and it's correcting. That's what they're saying. So welcome to Housing Bubble 2.0 News of the Week. Randy Patrick here, putting the realism back in real estate. Today's December the 1st, 2022. The year is 11 months gone, 1 month left, and it's almost over. Time flies when you're having fun. I can tell you that 2023 is going to be a heck of a year in real estate. So I hope you're doing well. So today we're going to get into some interesting information here. So I decided to check out just a basic website, yahoo.com. And the reason being because I go to very specific websites for mortgage, housing, data, information, news articles, whatever, different consulting groups, different economists, whatever. So I do that every day, but I thought, hey, I'll just check out what Yahoo's got. So here's the first page of Yahoo. I just did a screenshot of all the housing articles literally on the first page. You can see there's 3 there, all right, literally tons of them. Oh, more here. This is just from today, by the way, guys. More here, all right. Oh, look, what do we got here? Oh, more there. Look at this. Yep. Oh, home prices decline for third straight month. Back to $1 million mortgages, affordability issue. Oh, pending home sales fall. U.S. home prices slow. Treasury curve reaches steepest inversion. Robert Kiyosaki warns economies in biggest bubble. Michael Burry talking about extended multi-year recession. Canadian housing correction going on there in case you're interested. All right. Economist predictions, seller markets, buyer's market, lock-in effect. I mean, so much going on here. So that's what the average person, I guess, looks at with respect to news. I'm sure other sites are quite similar, but the point is, as far as information is concerned, that is dominating the news wire. All right. So housing is dominating the news wire, whether it's earlier in the year with hype and double-digit appreciation, or whether it's now going, hey, man, we're correcting. And this just came out today. So again, as I always mention, I'm really liking Fortune.com because they're putting out, especially this writer here, I guess. I don't know him, never spoken to him, don't know who he is, Lance Lambert, but he's been putting out some pretty good articles, updating constantly, and they've been really dialing in on the housing market and where things are at. So Fed Chair Powell, U.S. housing bubble formed during the pandemic, and now the housing market will go to the other side of that. Kind of interesting. So now you've actually got the Fed calling the housing bubble. Now, for those of you that have been living under a rock and you still don't think we have a housing bubble, I think, it's time to sort of give your head a shake, quite frankly, because virtually every major financial Wall Street institution has already said that we're in a correction, that we're going to lose minimum 20%, blah, 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 could be worse. And of course, the Fed is chiming in again. And this is funny because if you go back in 2005, the Fed chair Alan Greenspan told Congress that a bubble in home prices for the nation as a whole does not appear likely. Of course, not only had a housing bubble formed, it was nearing its peak when he delivered that message in Capitol Hill. And that's when there were some very poignant interviews on TV when he was talking about frothy markets. So him and Ben Bernanke were saying we're seeing some froth in some markets, but we don't think it's going to be sustainable. Yada, yada. Okay, so funny, we know how that worked out, right? So fast forward to 2022, and the scars of the last bubble have clearly made economists less afraid to acknowledge a housing bubble. That's right, because back in the day, it kind of hit us out of the blue, and nobody was copying to it. Nobody's going to admit it. Now people are getting ahead of it going, hey, we don't want to be the ones that are saying it's not going to happen and missing out on this, all right? So it's kind of funny how things reverse up. But again, we have a complete cycle that we can look at as far as history is concerned to help us predict the future, which is really helpful on a going forward basis. But on Tuesday, the most powerful economist in the world did just that. Speaking at an event, Fed Chair Jerome Powell told the audience that the run-up in home prices during the pandemic qualifies as a housing bubble. So for those of you who didn't believe what's happening, your own Federal Reserve is basically saying, we got a housing bubble, okay? Coming out of the pandemic, okay, blah, blah, blah. Anyway, I'll say, according to past statements by Powell, that process of bringing balance to the U.S. home market has already begun. In June, he basically said spiked mortgage rates would help to reset the U.S. housing market. And then September, Powell told reporters that we had officially entered into a difficult housing correction that would restore balance to the market. So that's what the Fed's actually doing. The Fed is actually saying we're going to fight inflation and we're going to raise interest rates, and that's also going to change the dynamic of the housing market. And the reason being, because I remember in June saying, well, first-time home buyers can't buy a home. The average home buyer can't buy a home. Average wages has not kept up with home price appreciation. And, trade up. People who want to, sell and trade up can't afford it. It's not working anymore. So obviously a reset has to happen. Now, we take a look at sort of the terminology here. Housing bubble was replaced by affordability crisis. I guess that was the correct way of saying things. And, now we're into a housing correction now. So we're not saying the word crash. We're saying the word correction because I guess crash still is a little bit too strong of a word, but and again, on a personal note, we're prepping for a crash. I believe just that we've gone through the bubble has burst, we're correcting now, and you know how I feel about the crash. The crash will happen when the foreclosures that are all backlogged sitting around behind the scenes and nobody talks about manifests and plays out. So anyway, just it's kind of interesting to see how, the perspective now when we've gone from no to hell yes, it's going to change. And by the way, speaking of all this, if you'd like me to send you my report from bubble to correction, then crash to crisis, how the housing market imploded in 6 months, send me an email at randy@luxuryshortsales.com. I'll fire that off to you, which basically summarizes all the things that have gone on in the past few months that point to the fact that we're going to have some massive housing issues. It's already started, and it'll be big time manifesting in 2023. So just hit me up with an email. And by the way, if you appreciate the information I provide, if you do me a favor and hit the subscribe button, I thank you very much. All right, guys, moving on. So interesting enough here, I'm going back to, on the Yahoo information. This is what people are seeing, right? So they're being inundated with housing. And, from I said, the layperson, the average homeowner who's not vested in the housing details like we are, they're just looking to buy a house and live happily ever after. There's a lot of confusion, a lot of anxiety, a lot of stress going on. What do you do? Who do you listen to? I mean, there's so much conflicting reports out there. It's tough to kind of, piece through all that narrative. Well, this is interesting. So this came out, I guess Learning Tree did a survey. A housing crash is coming, many consumers believe. A significant share of Americans, 41%, believe the housing market is headed for a crash in the next 12 months, and 3/4 of those think it'll be worse than the 2008 downturn. That's pretty surprising. So the average person is probably looking at everything going, you know what, we are way too expensive. We have too many headwinds hitting us from a financial perspective and the economy and the personal finance level. And we know, like the average person knows, housing is overvalued. And they see the rates. They know they can't buy a home or they don't feel good about buying a home. And therefore, home buyer sentiment is at record lows again. So I do think it's interesting that now we're hearing from the general public saying, yeah, this is not good and we're not going to participate. So this is where things change. I mean, you can talk about, all the headwinds and this and that, but it comes down to what people are thinking and what they're going to do. The difference from the last housing crisis to where we are today is the fact that we have much more access to available information and on a faster, quicker basis. So again, back in 2007 and 8, when everything was kind of imploding, it took a bit of time and a while to kind of figure out what was happening. Whereas now we're seeing on a daily basis, on a monthly basis, what's changing, and we can sort of look ahead and go, okay, this is the trend, this is the signs. Here's what's going to happen. So that's what's going on. So obviously the homeowners or potential buyers are picking up on this. A most important factor to cause a housing crash, well, 33% say inflation, higher rates 24%, no affordable housing 16%, rising prices 11%, high foreclosure rate 6%, supply exceeds demand 5%, higher unemployment 4%, and looser underwriting 1%. So, but in the end, these are respondents that expect a crash to take place within the next 12 months. So I do find that interesting because you see, we've all heard from the Wall Street guys, right? We've heard from Morgan Stanley. We've heard from John Burns Consulting. We've heard from Goldman Sachs and Fitch Ratings. And we've heard a lot from Moody's Analytics, which, as I said, they seem to be the ones producing the most information. We've heard from CoreLogic and some other players as well, too. Yep, there's always going to be groups who are going to sort of hold back and go, you know what, we don't see it becoming that bad. We think things will correct pretty quickly, blah, blah, blah. Well, typically they're trying to create their own narrative, and they're trying to basically, keep their businesses intact and keep their stock prices up, and not really trying to blow a gasket in the housing market. Simple as that. So we all know, we each can have our own separate narratives, and we can try to control our narratives the best we can. But in the end, Now we're getting to the point where this information's out there and people are really picking up on it, and they know there's a change coming, and that actually should make people happy, not because of the loss and carnage. I mean, sure, people will suffer along the way. That's just part of a normal cycle. Don't feel bad for people. It happens in stocks, it happens in crypto, it's going to happen in housing as well too. It's already happened in housing. We're just going to see it replay again. But the interesting thing now, it's becoming a lot more prevalent among just the average home buyers, average people. That's kind of what we're seeing now, which really, to me, makes it quite interesting. All right. This actually came from Mish Talk. He's got an interesting financial website. So he's looking at the major federal rate hike cycles here. So you can see that each one of those lines, colored lines, represents a year when the Fed hiked the rates, all the way from 1958 to current. But so of course that's why there's some interesting longer lines. If you take a look at where my arrow is, there's a short brown line there. That's the 2022 rate hike cycle. And essentially what they're saying is that, this is the steepest, most aggressive hiking cycle ever. And you can see the impact, especially in mortgage rates and thus housing. So yeah, the Fed is sort of stuck by its guns saying, we're going to raise rates, we're going to fight inflation, we're going to bring housing back down to norm. We've already heard from yesterday, the fact that they're going to raise rates once again in December. I guess the report is the Fed was dovish, okay, in saying probably 50 basis points, not 75, not 100 basis points, 50 basis points. So it's a little slowdown, but doesn't mean they're stopping. There's still reports that they're going to continue this in 2023. But interesting enough, though, that where we're at now is it's the steepest, most aggressive hiking cycle ever with respect to the rates. Now, moving forward onto that, we can see that, the 30-year fixed mortgage rate has gone up dramatically, almost exponentially within the period of a few months, 5-6 months, etc. That's put a big dent in the housing market, and we're trying to bring inflation and everything back down to normal. It certainly has affected the housing market big time. And you can see where things are at. So obviously, in January, this is information from NAR, National Association of Realtors. This is the existing home sale. So not new homes, this is existing homes that are bought and sold via the MLS every month. And you can see that the seasonally adjusted annual rate, the SAR on this. So if you go back to the peak there, that was January 1st or January 2022, you can see that where we were heading was about almost 6.5 million units bought and sold as a annual run rate. Now you can see where we are today at the 4.43 million. So we've gone down from essentially 10 months. We've dropped more than two. We've dropped to about 2.26 million units on the SAR. That just goes to show that there's been a significant pullback in sales activity. So basically, existing home sales are down 28.4% from a year ago. Existing home sales are down 31.7% since January. That's a crash. And never have we seen such declines other than in recessions. That's very interesting. So what we're seeing here, as he says, this is a crash in transactions, not in price. So what typically happens is people just pull back and they go, I'm not going to buy anymore. So retail buyers are not buying. Investors are pulling back, not buying. Institutional investors, the big players, they're pulled back 30% or more. They're not buying. So what we're seeing here is just less and less sales that are happening in the marketplace. So when the sales activity drops, all right, eventually the price point activity will start to drop as well too. So again, he's clear though saying that's a crash, but the crash is based on transactions, not price. Typically price crashing will follow. That's why 2023 will be pretty exciting as far as time goes on and what's going to happen. Going forward here, every so often Adam Data Solutions produces what's called their, most vulnerable housing market based on the declines in the third quarter. They did it again here. And what it does, it talks about at-risk markets in the country. They look at various counties across the country. They're factoring in things like, affordability, underwater mortgages, change in sales activity, foreclosure funds, whatever. So they actually take a look at this and say, here's kind of our situation across the board. Let's take a look at the top states. So the most vulnerable counties, again, clustered are in the Chicago area, New York City, and Philadelphia, along with sections of California. So basically, it's housing market troubles. We've got 28 of the top 50 U.S. counties are in the areas of Chicago, New York, and Philadelphia, as well as California. California markets on the list remain mostly inland, away from the coast. All right, you got like the New York area, Kings County, New York County, Richmond counties, which covers Brooklyn, Manhattan, Staten Island. 5 of the New York City suburbs. Essex, Passaic, Sussex, and Union counties in New Jersey, and Rockland County in New York. 7 in the Chicago metropolitan area, Cook, DeKalb, Kane, Kendall, Lake, McHenry, and Will counties, all in Illinois. The 4 in Philadelphia, as well too. Gloucester County, New Jersey, Newcastle, Delaware, and Cecil County, Maryland. So basically, we got a lot going on. Okay, another 11 were scattered along other parts of the mid-Atlantic region. So we got a lot of things happening. So this situation is just the same as the last housing crisis. Okay, because you do have higher price points there. People still suffering, even for the last housing crisis, still underwater properties, lots of foreclosures, price points being dragged down for more foreclosure fines starting, existing home sales slowing down big time. So this is what's going on here. So I don't be surprised, but I guess the point is that various locations across the country are going to experience this quicker than others. When we take a look at the last housing crisis from peak to trough, it was a general across the board at 27.4% from peak to trough decrease in home price value. We've got, again, as I said, Morgan Stanley, CoreLogic, Moody's, John Burns, Fitch, Goldman Sachs, etc. Everyone's predicting at least the 20%. That tends to be the number, at least 20% from a, sort of, we'll call it, marginal perspective here. I think a lot of people behind the scenes are saying it's going to be more than that. We hear our intel 30 to 40%. Some markets are going to get hurt pretty bad. Some will fare reasonably well, still be losing. But across the board, I think the 20% is pretty what's what I'm looking for. Pretty conservative at this point in time. It's going to get worse before it gets better. Also, from the intel that I have, that this is going to happen quicker than anticipated. So we're going to hit bottom a lot faster, probably within about a 2-year time frame. So if you're not looking at this business, if you're not looking at buying a home, if you're not interested in what's going on before, this is the time to do so now, because this is actually going to happen. All right, we're really sort of it's actually bubbling up and things are changing in the marketplace. So don't miss out on this opportunity. So if you want to find out what's happening in your neck of the woods of your market, go to gethousingdata.com. That's gethousingdata.com. That's my affiliate link with foreclosure.com. Go check it out. You can see the distressed properties, the pre-foreclosures, the auctions, the tax deed, the short sales, all that right there in your own backyard. Pretty easy to see what's happening, again, in your area to determine what you want to do. So please go and check that out. If you want to talk to me about opportunities, you know what? I'm looking to do a lot of different things. I'm working through a lot of stuff right now, and we're expanding, we're growing. This will be a great opportunity. As much as the bottom will hit, the prediction is by some groups saying a little faster than before. This will still be the 3 to 5 year play. So my point to everybody is learn this now, figure it out now, get ahead of the game, get ahead of the curve, because quite frankly, there's a lot more investors, a lot more money, a lot more people ready to swoop in to take advantage of the next housing crisis. So if you want to get your hands on something, your own piece of the action, whether it's a primary residence, whether it's investment home or fix and flipping, earning income, whatever you want to do, build wealth, I suggest you start looking at this a little more seriously now before it's too late. Always be ahead of the curve. I like to talk about this because I like to see the trends, and I want us to be ahead of the curve because we can see the trends and we can jump on that faster than the masses. That's the whole point I'm trying to make here, guys. So by the way, thank you for the views, likes, comments. Please share the video with your family and friends. If you're not a subscriber, please subscribe. We'll look forward to speaking with you sometime next week. Take care.